Well, I promise not to read from the book. Generally speaking, it's better to talk about the book and frame the arguments and then put them into a context. I may quote 4 or 5 numbers, which I think are very much to the point, but I guess I don't think of that as reading from the book. Let me start out by saying that the background to this book is not terribly unusual, but a little bit so. I started dealing with these issues as part of a 3-part framework in a book I brought out back in 2006 entitled American Theocracy. And its subtitle was The Perils and Politics of Radical Religion, Oil, and Borrowed Money. Now, the radical religion came to the fore in 2006, very much that same year, and the Republicans took a bad hit in Pennsylvania and Ohio, essentially running under the banner of the religious right in 2 statewide races. I'm inclined to think, barring some very unusual circumstance, that the real threat that was posed by the religious right in the context of George W. Bush and his own commitment to some of the biblical prophecies and interpretations probably passes with him. I can think of ways in which it might be brought back to life if we had another 9/11 type of episode, but I really doubt it. So what I decided to do in August, when the credit crisis materialized and everybody went through a very interesting month of wondering what was happening to the economy, was to go back to the economic side of what I had looked at. And that was on the assumption, based on what happened in August, that the whole thing was going critical, as they would say in nuclear circumstances, and that we were really moving into a significant crisis. Now, at this point in time, as some of you will know and will have followed, you have people like former Fed Chairman Paul Volcker talking about what's going on now as the mother of all crises. As a former president of the World Bank just became about the 3rd or 4th well-known figure to suggest that the total damage of this upheaval was probably going to be more than $1 trillion. You have Professor Robert Shiller at Yale, who's been the principal forecaster of a big decline in real estate, continuing to stick in what seems to be an only slightly hedged projection that we're going to have the biggest downturn in home prices since the 1930s. So my view of this is only the 2nd or 3rd inning. I don't think we're even remotely halfway through this. Now, just by way of an odd calculation, I was thinking this as I was going over and figuring what I might add to my speech outline. Back in August, when the politicians were getting concerned, they tended to predict that the damage of this episode, by the time all the dust had settled, would be somewhere between $100 and $200 billion. A friend of mine who is an economist wrote something in the Financial Times about 2 months later, and I quoted him, and he said, thought the damage would be at least $250 billion. Then, bit by bit, as the new year rolled around, you had a couple of brave souls talking about damage in the $500 to $600 billion range. Now, most recently, you've seen the numbers ratchet up to 800, 945 billion, $1 trillion, etc. Now, my guess is by the time the whole thing is over, the damage is far more likely to be something in the neighborhood of $5 to $10 trillion. Now, trillion isn't terribly meaningful as a concept because we can't imagine what it is. However, the U.S. gross domestic product is about 12 or 13 billion, and it's conceivable that the damage out of all of this could run almost that high. Now, before I get into the details, let me explain what I'm thinking about. The bare bones damage from debts that can't be repaid, collapsing values on certain financial instruments, and so forth. I'll go with the $1 trillion on that and stake the larger case on some other aspects. If in fact the value of housing was to go down between 10 and 15% nationally from its peak, the loss in net wealth to the United States population would be about $3 trillion. So that kicks it up to 4. Now, one of the things that we've seen in recent years, ever since the invasion of Iraq and the very unsuccessful occupation and attempt to get the oil fields in order, is that the price of oil has basically gone up by 500% since the invasion of Iraq. Now, one of the reasons for that is the loss of confidence on the part of a lot of people in OPEC, a lot of oil producers, in both the United States and its Middle Eastern policy and the dollar. Now, the decline in the value of the dollar against the euro since, 2001, 2002 has been almost 50%, but you've had about a 15% decline since last year. So if you take 15% off the value of the dollar in terms of everything that's denominated in dollars, a lot of money there too. And if you take the indirect tariff in the price of oil and how that's risen as the dollar declines and the burden on the US economy and the fact that we have to spend between $400 and $500 billion a year now on oil imports, you start, again, you just put more zeros into the equation. So my guess is by the time all the dust is settled, and if I had to pick a year, 2010, something like that, I think we're going to be looking at something where the tab, the burden that it's imposed, the cost will be enormous, just enormous. And the title of the book, Bad Money, is, well, the dollar is sort of becoming bad money if you're a retiree in Europe. You don't think that the dollar is living up to what you thought it would a long time ago. It's weak money. I suppose you could say it's bad money. I use the term more in the sense of bad money like bad dog, bad Wall Street. Bad people who should have been doing something more efficiently and more intelligently and with a greater sense of responsibility than they were in fact doing it. And that, I think, is the fundamental problem. Now, let me go on to the nitty-gritty here, having sort of framed a larger picture of the money that could ultimately be involved. Now, granted, that's a pretty far-reaching definition. Now, in some ways, I think a good analogy to describe what's going on is to think of the US economy as having fallen into something that's turned out to be a shark tank. Now, the shark tank is important because if you go back and you look at the 20th century, the sorts of recessions that we had at 3, 4, 6-year intervals, distances like that, they mostly came out of the infrastructure of the manufacturing economy, out of excessive inventories, out of the need to lay people off because there wasn't the amount of demand, the sort of thing you would expect if you had an economy, which would have been true in the 50s and 60s. It was at least 30% manufacturing. Now, by the 1970s, it was starting to change. The percentage that was in manufacturing was down to 25 to 27%. And the percentage of what was then gross national product that was in finance was about 10 to 12%. Now, as the years go by, you get up to the late 1980s, and we're starting to look in the late 80s and early 90s at gross domestic product, which is a slightly different measurement. You see that manufacturing is down to 16% or so, and financial services by this point are coming up to about 16. Well, the number by the time you get to 2003, 2004, when the mortgage market was about as hot as it was going to get, was that financial services accounted for between 20 and 21% of the GDP, and manufacturing was down to 12%. Now, part of my thesis in this book is that the financialization of the United States is unprecedented and very dangerous. A lot of the rest of it ties in to debt. Then you have the questions of this sharp decline that everybody expects, and we're starting to see already, in home prices and what that might mean. Then the next shark, we're looking at number 4 here, is commodity inflation. This has started around the world. People are starting to see as much of an increase in the cost of milk as they are in the cost of gasoline. We're looking at a commodity inflation that goes beyond energy or agriculture, partly because agriculture and energy are starting to overlap with some of these grains and corn and sugar being alternative sources of fuel. All of this gets enormously complicated. Then you've got the question of peak oil. Now, peak oil is controversial if you take a wholehearted commitment to the notion that we have just about peaked in global oil production and it's downhill from here. I think the more relaxed and perhaps a wiser interpretation of the peak oil question, and this is pretty widely shared, not a majority, but pretty widely, is that we're likely to have a peak in global oil production sometime between 2020 and 2030. The United States peaked back in 1971. The newspapers were full of stuff about a week ago that Russia has probably peaked. We know Mexico peaked some years back. The non-OPEC countries will peak next, and the last to peak will be essentially the Persian Gulf and perhaps Brazil and who knows, Venezuela. But essentially, the demand is growing faster than the likelihood of increasing production. And this makes for a very difficult circumstance because you have shrinking resources potentially involved along with the commodity inflation. Now, shark number 6, which is a particular favorite of mine, not because I'm interested in the shark aspect, but it's because I think Americans have been so gullible about this slow change for 30 or 40 years. I did a piece, which is the cover story in Harper's this month, and it's also in the book, but there's actually a little more in Harper's, on the weakness, I would say the fallibility and the dishonesty of US government economic statistics. Now, the explanation of this is enormously complicated. We spent a lot of time checking every little bit of language and trying to make it either broader or more accurate, and I'm pretty content with what came out. But the long and the short of the Harper's thesis, and the inflation part is in bad money, is that you can't trust the government data, partly because every president since the 1960s has wanted to put a slightly happier face on everything, to make the troubling aspects less controversial, to find a happier way of presenting the data, to take a nicer part of the alternative series. And there's a fellow who runs an outfit called Shadow Stats, and he calls it Pollyanna creep. That's actually a pretty good thing, because I don't think any of the presidents sat down and said, hey, I'm really going to fix this one and it'll make a deception web that nobody will be able to figure out. I think they added to each other's games. Nobody did it all. Nobody even did 20% of it. And that they never had some great meeting that decided on even 20 or 30% of it. But what they did have is a sense that, well, they changed this. Okay, it's not inconvenient. I think I'll keep it like that. It does disguise things a little better. Bit by bit, you've got to the point where I think some of the larger changes came under Bill Clinton. Fittingly for a man who's thought of as a man with a happy zipper, a hedonist, is they introduced in the CPI, Consumer Price Index, a approach called hedonics. Now, hedonics was to reduce the prices of things that were going up in price to allow for the pleasure that the recipient and the satisfaction got from the improved quality. Now, what happened here was tricky in itself, because they kept reducing prices because it was a nicer television. I mean, I remember growing up during the 1950s, and the screens went from the size of a postcard to something you could actually see from 8 feet away. That was awfully hedonic, hedonistic, whatever you want to do, but they never played around with anything back then. They only started doing this stuff in the 90s, and the reason was they needed to play around with the inflation rate because they needed to save money in terms of pensions, Social Security, keep business from having to pay higher cost of living benefit increases, and keep the pressure off the bond market, which was very considerable too. And the upshot to me, if I just had to take the numbers, I would say at this point, and we can see global commodity inflation, the Federal Reserve Board, as recently as January, said American inflationary expectations were anchored. And this time, right at the same time, there were polls showing that inflation was the #1 issue and gaining rapidly for Americans. So it wasn't anchored. And it's even less anchored now. And the notion that they can say that inflation is between 2% and 4%, a lot of people overseas in the financial markets, where they distrust the American dollar, say that inflation, including food and energy, is probably between 6% and 9%. I'd say that's about right. I think that's about where it is. And that the notion that all these data are out there with numbers that people are finding it harder and harder to believe. And Barack Obama's chief economics advisor is a fellow who wrote an op-ed piece in the New York Times 5 years ago saying that the Bush administration cooked the books on the unemployment data. So I think we're nearing a point where all of this is going to become an issue, and I think it'll be a big problem for the dollar. Now, let me close by looking at the dollar. Essentially, the American dollar has been a pretty strong currency most of the time up until the 1970s, when essentially the United States stopped giving foreign central banks gold for their dollars, and in essence went off a partial gold standard. Well, in 1974, people tend not to remember, and it wasn't that publicized at the time, but the administration, the Nixon administration, with Henry Kissinger doing a lot of the negotiating, when OPEC wanted to raise the oil price and was prepared to do it themselves anyway, the US government went along, and this is when it went up from like $3 to $6 or something, only the barest shadow of what we have today. The US government agreed to this, and then the Saudis and OPEC agreed that they would sell oil and buy oil in global markets using dollars, and that they would recycle the petrodollars they got from selling oil to the West and put them in US Treasury debt. So the arrangement really was that the oil business would continue to support the dollar. Now, this persisted even though the percentage of America's oil consumption that was actually produced in the United States really went down. We now produce only 35% of what we need, and the bill for oil imports each year is in the neighborhood of 400 to 425 billion, as I mentioned. So this is becoming enormously costly. Oil is now a boomerang. Instead of supporting the United States and supporting the dollar, it keeps rising whenever people want an alternative to investing in the dollar. Now, some people just don't want to have the euro as an alternative to investing in the dollar, because they say, well, European Union, that's not particularly strong. Why should we pay a whole lot of attention to them? They don't have one major financial market. London isn't in it because the British have not gone into the currency part of the European Union. And they have no army, and the American military protects some of the people in the Persian Gulf and Japan and some other countries. So what you get is the big increase against the dollar hasn't been by the euro, it's been by gold and by oil. And oil is up essentially 500% since the Iraq War, which was another triumph of planning, because part of what they were trying to do was bust open OPEC's oil. And they succeeded not only in not busting it up, but infuriating OPEC, and OPEC has let the price go up 500%, partially as a raspberry for the administration, and partially because they are happy to have an alternative to the devaluing dollar. Well, the long and the short of this is we have a convergence of a whole set of problems in which the United States is confronting simultaneously the financialization of the American economy, record levels of debt, the collapse of home prices in some parts of the country, like California, very severely, the rise of global commodity inflation, the question of peak oil, whether there may not be the beginning of a growing physical shortfall in oil, the question of lousy economic data, which is a little more than that, and then the question of the declining dollar. Now you put all of these things together, I don't think we've ever had 3 or 4 of them coming together before, and this time they're all coming together. Now let me give you some details here, because I think it's very useful to come up with some of the details to frame what's going on here. I gave you the numbers on the financialization of the American economy, that it's gone from being 10 to 12% financial services 30 odd years ago to being 20 to 21% now, while the share represented by manufacturing has collapsed from 25 to 27 down to 12. Now what this means is, in a nutshell, finance is the biggest thing in the private economy. Government might be a little bigger, I'm not sure, it's pretty close if you take state and local and federal. So you've got this huge gargantuan financial sector which likes to pretend that it's just some little outlier out there, and that the real economy won't suffer because something is happening to finance. That's nonsense. Finance is the real economy. Finance is where you make the money. Finance is the debt and credit industry of the United States, and very few people aren't dealing with the debt and credit industry, either through credit cards, through mortgages, or through having financial instruments and financial securities that are affected by the games that have gone on in the last 6 or 7 months. So the importance of this is huge. Now, the second thing about the growth of financial services, it's been very closely related to the growth of debt in the United States. Now, a lot of people will say, well, the troublesome debt is the federal budget deficit. In fact, you know, that may be true 10 years from now when a lot of the entitlements are like the pig coming through the python. But right at the moment, the real problem has been the absolute abandon in growth of private debt. Now, let me give you some numbers here, and as I promise not to read from the book, but it's easier to read the 4 numbers and to try to remember them. These are the 4 numbers, the growth of outstanding debt in the United States, the combination of private and public between 1984 and 2006. 1984, the total debt, $7.4 trillion. 1994, we're jumping rapidly now, $17.2 trillion. 2004, jumping even more rapidly, $37.6 trillion. 2006, $44.7 trillion. Right now it's closing in on $50 trillion, but nobody's sure exactly the size of debt now, and some of it shrinking. So what you have is this extraordinary buildup of debt. Now, what built up the fastest wasn't the government. The government debt, federal, went from $3.5 trillion in 1994 to $4.9 in 2006. That's not big compared to the rest of it. The biggest growth came in the financial sector, the domestic financial sector. This is the number for financial institutions borrowing so that they could grow and have more money to speculate with. Instead of putting $3 on Red 21, they put, $3 million on Red 21, they put $90 million on Red 21. And if you only make a 1/16 of a point, well, the 1/16 of a point is worth a lot more if you've got 30 times as much. It sounds silly, but you know, in point of fact, these are the numbers. This is the size of domestic financial debt in the United States. This is debt taken out by the financial sector, banks, investment firms, broker-dealers, hedge funds, all of these things. 1984, $1.05 trillion. 1994, $3.8 trillion. 2004, $11.9 trillion. 2006, $14.2 trillion. That's the fast growing. And that's where they got all the money. They got all the money to make mortgages that wouldn't pay them too much for a couple of years because you went in and all you had to pay was interest, or you got to pick the amount you would pay, or any number of flavors. And sure, in 2.5 years, they became a bear trap around your leg. And that was sort of the point. And it's not to say that a lot of people weren't gullible too, but the essence was that they had the money to speculate. They had the money to not get too much out of the mortgage in the first couple of years because the going got a lot friendlier later. They had the money to advertise incredibly to promote credit cards, especially among younger people, and the deregulation of credit cards was making 15, 18, 25% interest was relatively commonplace, and the fees were soaring. So this sector was making a bucket of money, absolutely huge amount of money. And the importance of debt and credit in the United States was growing rapidly. It was one of the leading growth industries. So where does this leave us? Well, you get another staggering pair of numbers. There have been two huge growths in debt in the United States in the last century. The first came in the 1920s and early 1930s as the economy shrank and debt didn't shrink as quickly. You had debt peaked out during that period at 287% of the gross domestic product by our present use of that term. Well, by 2007, the most recent growth in debt was far bigger. It was between 335 and 340% of the gross domestic product. And it came and it grew rapidly, as I said in those numbers. It was staggering how fast it grew. And the principal man in office whose term overlapped all of this was Alan Greenspan. And the two presidents who were probably the most responsible for the huge growth in debt were but very bipartisan, Bill Clinton and George W. Bush. And the result has been that you have this huge, towering mountain of debt, and it's hard to know exactly what part of it's coming loose, the rocks and stones and coming down on us. Probably a good bit more will before all this is over. Now, as to how we deal with this, let me just close on these points. Basically, I think it's going to be enormously difficult to deal with it. First of all, the politicians won't discuss the numbers. I bet very few of you have heard those numbers about the percentage of the GDP that financial services climb to, about the enormous size of growth as a percentage of the debt, as a percentage of the GDP. The numbers about the growth of debt, basically not published much. And every time that I check to see whether they've been published, I still don't see much beyond Googling and getting references to my own book and things I've written. It's not a happy conversation for the people involved. And you do not have the Democrats and Republicans anxious to blame this on each other because they can't. This is the pot and kettle. Anybody that looks at the numbers, one of the reasons why Bill Clinton was so anxious to reduce the federal budget deficit in the late 90s, which they did because they had a huge amount of money coming in from capital gains profits on the tech bubble. During this period of time, you had an enormous growth in private debt as finance was being deregulated in a number of different ways and really getting equipped to do all kinds of stuff. And then it went to George W. Bush. The tech bubble burst under Clinton, but the Republicans ginned up the housing bubble. And they decided that would be the way you could stimulate the economy again big time. And Greenspan had been very knowledgeable about previous periods in the 1970s and late 1980s when fast-growing home prices had allowed people to refinance their homes and take money out which they spent on other things. So by 2003, 4, 5, even 2006, something like 6 to 7% of the US national income consisted of people who had refinanced homes, spending that money on something other than real estate or homes. So in other words, it took a huge amount of disposable income out of using homes as an ATM machine. Now at this point, what we see is the drop in home prices may, by the end of this year, nationally be down 15% from the peaks back in 2006. That's where the peaks were in California, not everywhere. But depending on how far this goes, there are quite a few people that think that the national loss in home values will be 20 to 30%. It won't finish until about 2010. I should say that in California during the 20s and 30s, you had a huge decline, and it didn't finish, according to most of the analyses, until 1939 and 40, on the cusp of World War II. So we clearly have something pretty big coming in housing that, instead of giving consumers money to spend, is going to be taking money out of the psychologies of consumers and out of their wallets as they watch, certainly in the Sun Belt in particular, as they watch their mortgages go underwater as their home loses more value. And there are going to be parts of the country that are going to be very heavily impacted by this. I haven't seen Oregon in the statistics. I don't know what your story is up here. But the ones that figure most prominently are Florida, and then the Southwest, Arizona, Nevada, Colorado, and California, and then the industrial Midwest with a different set of problems, that's Michigan and Ohio. And if you assume that consumer spending drops significantly and consumers stop providing, in essence, 70% of the 70% equivalent of the GDP with their purchases, you're going to see a lot of businesses slow considerably. And that's part of the reason why people that look at this whole unfolding pattern basically think that we're really not too far into it yet. The other yardstick, it's fascinating if you go back and you look at the Great Depression, the first major financial firm in the sense of brokerage house only failed in 1931. They didn't fail in 1929 or 1930. Here we already have Bear Stearns went belly up, and who knows how many others will have been weakened fatally, and we won't know it until another 2 or 3 more years. So there's been more upfront damage in some ways this time, but I don't think anybody has any expectation that there's going to be an 80% decline in the stock market like there was between 1929 and 32. So let me conclude by saying I don't think the government can really deal with this, and the only way they'll deal with it is when the new Congress and the new president are inaugurated and start thinking about policies in March and April of next year. If the economy is ratcheting down significantly at that point, I think you will see a bipartisan panic, and they will really be anxious to take some pretty serious measures. Right at this point in time, everybody believes that there won't be any serious financial reform done this year because they'll be waiting for the elections. And the White House has said that they expect a major upturn in the summer and the fall. So everybody's waiting for that. If it doesn't come, then nervousness will rise rapidly. And if it still hasn't come by March or April, you can expect to see a whole panicked bunch of politicians. My guess is, it's not going to come quickly, that we're going to see further down legs, but I'm not sure how they're going to come. They have so many pockets they can come out of. They can come out of real estate. They can come out of some crisis in oil. They can come out of imploding debt. They can come out of a dollar collapse. There's just all kinds of things that can happen. And the idea that we are being presided over by George W. Bush here is not exactly a second coming of Napoleon, or anything really for that matter. I don't have a whole lot of faith in anything he can think about or do. I wish I could say I had a whole lot of faith in what some of the Democrats might do, but it's not much more extended. Well, let me stop here, and I'll be glad to pick up on any aspects of this, and there's a lot more detail I can get into, and you can go into the election a little bit, although that's not too encouraging either in a lot of ways. So let me stop here, and I'll be happy to pick up on any points you might like to pursue. Thank you. Sure. Anybody at the microphone, just go ahead when you get there.
Can you make a comment about how this economic circumstance might create a change in the relative power of our federal government as opposed to the power of international large commerce?
Well, I think you could get a rise in the power of government partly because what we're seeing around the world at this point is a growing return to the role of government, whether it be in oil pricing. 80% of the oil resources are now held by state-owned oil companies, mostly in Latin America, Asia, and Africa. You're seeing more and more assertion against what I would call the global pro-Western enforcement mechanisms, the International Monetary Fund and the World Trade Organization. They're losing breadth of support. The United States pushes for them, and some of the European countries do, but there's a lot of question there. There's an increasing assertiveness now of different energy alliances that are hostile to us. You've seen the rise of what they call the sovereign wealth funds, and these are mostly in the Asian manufacturing companies and in the energy producing countries. And they tend to parallel the places where the central banks are accumulating huge amounts of dollars and currency resources of staggering levels. The Chinese National Bank has 1.6 trillion of reserves and about $500 billion worth of treasury debt. So you're looking at all this money cropping up in these areas where government calls the shots, where a market economy has a role, but the state economy also has a role. And I think that what we're beginning to see is the increasing reassertion of national power at the expense of some of the multinational organizations that were associated with what they called the Washington Consensus. Now, I think there's a larger pattern involved here, and that's the weakness of the speculative brand of capitalism that's been associated historically with, in sequence, the Dutch, the British, and the United States, and the increasing dissonance on the part of the Germans, the Italians, and the French, who have a much less speculative capitalist approach. And then especially the Asians, who have a quite different approach in which government plays a major role. So I think that the role of government is already a major problem for the big US oil companies because they're not welcome. They're not welcome in a lot of these places because they don't want to deal with what they think of as sort of the vestiges of colonial power, the British and American oil companies, and they'd rather deal with other state-owned oil companies, which is very interesting because it causes huge problems for Exxon and Chevron and Shell and BP. They don't want to make deals with them. They want to keep full control, except for having bargains with other national oil companies. I guess they see them as peers. Now, this is an enormously difficult set of circumstances for the US oil companies. They don't have nearly the clout that they used to have, and they're not happy with what happened in the White House, because you had the United States go barreling into Iraq and the price of oil went up 500%. They don't mind that, but what they mind is that they've been dealt out of the international oil business in a lot of ways by the rise of these national oil companies who basically don't like the United States. And Venezuela will no longer take dollars for oil, and neither will Iran. And the Japanese and Chinese are perfectly willing to pay them in non-dollars. They pay them in euros and yen and yuan and so forth. This is spreading. And I think that some multinational corporations will be able to deal with it very well, but not all. Some are linked to bad memories, and they're not fungible, and they're not opportunistic enough. So I think you're going to see some resurgence on the part of the federal government. That's typical when you get hard times in the economy. You saw some of that in the 1970s, and you saw it in the 1930s. And I think there'll be elements of that in the next 3 to 4 years. I'm assuming the Democrats win, although they have this extraordinary ability to snatch defeat from the jaws of victory. It always boggles my mind, how they can do this. The talent pool they have to pick from is not terribly good, but it's better than what you might think. For example, in 2004, John Kerry from Massachusetts had a qualification that was not well known. He was the lieutenant governor when Michael Dukakis was the governor. Now, Michael Dukakis was the guy who lost to George H.W. Bush. So you would think in 2004 it might not have been thought of as a smart thing to pick the lieutenant governor of Dukakis, but they did. And right at this point in time, you're watching the Barack and Hillary show. I don't know how that's going to end. I think they have to somehow come up with some sweeping deal that includes almost a renegotiation of the different roles of the president and vice president, and then even the roles of the executive office vis-a-vis Congress. Otherwise, John McCain, who's seen as maybe a little too old to be president, but essentially an honest man, could win. And people don't want a Republican president. The Democrats have a 13-point generic advantage now, but they can take care of that. That's not too hard for the Democrats. They can do 13.
The perception has been that China and India's economies have been booming lately, much better than ours perhaps. I'm led to suspect that they may be heading toward cliffs in terms of energy and food production. China has switched from being a net exporter to an importer of grains, and that seems likely to get worse. China in particular is holding huge reserves of devaluing American dollars, and I wonder what you think they might be wanting to end up doing with those.
Oh, well, that's really, I'll date myself by saying that's the $64,000 question. Nobody really knows what they're going to do with it. They've got all these dollars. The Japanese are now starting to sell their dollars. They're being pretty blunt in their comments. But the Chinese have a dependence on the American market in terms of selling their goods, much more than the Japanese do. And I think they're torn. But one thing that people don't sufficiently appreciate, again, is China has replaced South Africa as the world's leading gold producer at this point. And there are people on the governing board of the People's National Bank of China that want to start buying gold, use some of their reserves to buy gold and not dollars. And the point being here is that it wouldn't take too much if they spend $100 billion or $150 billion a year on gold, and their reserves are going up by something like $300 billion a year. They could do that with no problem. They would run the price of gold up. They would make a fair amount of money on gold, probably as much or more as they were losing on dollars. And since they're the leading gold producer, they could be producing gold that might be selling in 3 or 4 years for $1,600, $2,100, I don't know what. Certainly hasn't really gone anywhere yet, but I suppose it's possible. The Chinese have an awful lot of cards. The weak card that they have is that they too could have a speculative implosion. It's not too hard to imagine, and everybody assumes they won't have it before the Olympics in the summer. But what happens after the Olympics? There were a number of bad weeks in the Chinese stock market until this last week when they started going up again. So I think that's an X factor out there. I think it's very difficult to know what's going to happen with India and China in the near term, whether they have a cliff may not be the point, but whether they have a major significant correction that affects the price of resources. But one of the big resource companies, Rio Tinto, did a survey in which they basically predicted that even if China went into a recession, that wouldn't have much impact on the prices of oil and copper and so forth. And one of the reasons it won't have as much people assume that other countries are being hurt by paying the same price we are. That's wrong. Other countries have strong currencies, so that they're not paying nearly as much of a growth in the cost of energy as we are. We get the bottom of the barrel because we have the currency that's losing its oil relation in the positive sense and developing a negative correlation. And nobody has the burden from the change in oil prices that the United States or any country whose currency is linked to ours has. So I don't know what's going to happen with China and India, and I do think that's an X factor. I can't say otherwise. I think it could be.
Hi, I made myself wait till tonight to get this book. So you may talk about this in the book, but I thought I'd ask anyway. I've been reading your stuff for a long time, and I wondered what connections you would make between the bad money analysis and your other major themes of sort of wealth polarization, loss of democracy, and also does this have a connection back to the cycle of declining empires that you talked about in the last book?
Absolutely. I don't get into that too much in this one, but I do review it because it struck me that I had never before written about the paralysis of politics that tends to come in these leading world economic powers when they start to decline. If politics is never able to do more than talk about these things, reform has been impossible because you either have parties breaking down, or you have entrenched factions, or you have interest groups that can't be overcome. So that despite a small amount of debate in Britain and a small amount of debate in Holland and a small amount of debate in Habsburg Spain when they were the principal world power, not too much happens. It's easy for me to imagine that that's the case again, and that the pattern involves much more than finance. Just out of curiosity, if anybody has it, the factors that I have identified as being relevant to each of these declining world powers is first, as they go past their peak and they start to go downhill, there's a general sense on the part of the public of a malaise, to use our word, that things aren't right and people aren't patriotic anymore, or they're immoral, or the society is unjust, or it's losing headway, or all of these things. And of course, 81% of Americans right now think the country's not on the right track. These countries had maybe not comparable numbers, but they had major axes of concern, and that was written about. It's just that the politics couldn't pick it up and deal with it. The other thing that you got in these countries was a polarization of wealth. As countries move into finance because they have the global opportunity, finance distributes benefits pretty narrowly and exacts tribute pretty broadly. Whereas manufacturing was something that made the middle class people out of the blue collar workers in the Great Lakes, for example. Finance doesn't do that. So finance is a late stage, and financialization has been a bad stage for each of these powers. It doesn't lead to nirvana. It's not a new era thing. It's just it's a sunset, not a sunrise. And I'm afraid that could easily be the case again. Another aspect that comes into play, and this is the reason why the last book focused more than anything else on fundamentalist and missionary and expansionist type religion, is you tend to have aggressive religions in these periods, whether it was the Spanish with the Inquisition. The Dutch weren't the best example, but then the British with their great missionary impetus to bring democracy and the British way and everything to the whole world, the white man's burden and so forth. And then we pick up on a lot of the same stuff the British did. Now, equally, all the different countries got the sense that the world was their oyster. They had took on much too much of a military burden beyond what they could afford. Debt mounted for a lot of reasons, not least the world ambitions and the world military outlays, and that became a parallel. And then, of course, debt. The British, who were the biggest creditor country in the world in 1914, were taken to the cleaners economically by the debt of 2 world wars. And by 1949, just 35 years after 1914, when they were top of the heap, they devalued the British pound, and it was worth only half as much as it had been worth back in 1914. So as I watch the dollar, I think of the pound. And in no sense can you say that declining currencies for the leading world economic power are some great benefit. They're not. So these parallels are significant, and I only got into them slowly. I started with the economic ones, then broadened it, and then under Bush and company, the parallels seemed to complete themselves. And as a result, I put a lot of emphasis on them, but I have to say the knowledge of them has come slowly because it isn't principally what I do, and I can understand full well that a lot of people would find that as reaching. But I don't think it is. I think it's quite relevant.
Everything you've said and everything that I've been reading lately, looking at the increase in debt, potential collapse of financial instruments, the loss of discretionary income, the pig and the snake that is the baby boom generation moving through our economy, having shifted from a manufacturing economy to a finance/service economy, which is driven by discretionary income. How does Joe Blow survive the coming collapse, and how do we prevent the rise in fascism, which is a normal response?
Well, it's not a normal response in the Anglo-Saxon countries. In other words, you didn't really see that in the UK. They had Mosley and his what did they call them? Well, they were British fascists, but they didn't really get anywhere. The Anglo-Saxon tradition doesn't do that. I think it's far more likely to go for a kind of apple pie patriotism and nationalism, maybe Christian nationalism, as I think we started to see with Bush in the Middle East. But I really wouldn't think fascism. There's just no fascist precedent in the English-speaking countries. But I think that the problems could be quite severe. It's difficult for me to see how we turn them around. The politicians don't want to focus them, partly because nobody has clean hands and they don't have any obvious solutions. So while I'm not concerned that there's going to be some sort of fascism, I think that there'll be a fair amount of bitterness, especially in the states where housing prices are falling.
Given your last answer, maybe you've already answered this question, but with the amount of pressure that's on the dollar today and with no clear relief in sight, and given that real inflation might be in the neighborhood on commodity products of 7%, and oil prices, I heard a projection today that within 5 years, oil prices will be at $200 a barrel. I think 118 is plenty for us to worry about it. What's holding the stock market up? Why doesn't the stock market respond to this news?
Well, this is something that I get into in chapter 3 of the book, and I could take it further than I did in the book. In the 1970s and 80s, you started to see a real growth in the United States of principles of the efficient market, the sense of the marketplace as sort of the ultimate new arbiter of everything as government became clumsy. Let business do it, let the market do it. And the financial markets were evolved as this great role player and adjudicator, and you couldn't mislead the market. The market analyzed the information and nobody could do it better. And this has looked kind of stupid in the last year or two, but it had a pretty strong hold, especially among people who were monetarists, mostly conservatives, and who were disciples of Milton Friedman. And Milton Friedman actually had, I think, a broader view than a lot of these people do. But Ben Bernanke at the Fed is a monetarist, and so are several of the other governors who have co-authored tracts and pamphlets with him. And they have this view that if the markets aren't factoring it in, don't worry about it because the markets are right. And I had some fellow that put up on his website a couple of days ago an attack on me because if there was an inflation problem, as Phillips says, the markets would reflect it. And my view is, no, they have a vested interest in trying to minimize it. But then he would reply, I think, that, well, there'd be plenty of sharpshooters that would be out there in hedge funds trying to take advantage of it. And they would say, all these inflation numbers that our government's putting out are a fraud. Well, a bunch of people that are in the hedge fund business and so forth are saying exactly that. And a number of foreign money managers are saying that. And the extent to which the world is losing faith in the dollar, and to some extent faith in our statistics, I think is going to be a blinding revelation for the people who are believers in this whole spirit of the marketplace. The market is never wrong, and they're mostly conservative economists. And I think they're ready for sort of the same flirtation with a bad chapter in history that the crowd under Hoover got back in the late 20s. Because I think they're basically misreading what's going on here. The market sometimes doesn't predict things. The market didn't predict things in early 1929 very well. If it was such a great predictor, why didn't it figure out that the country was heading for the toilet? Well, because the people who were in charge of the market didn't think the country was headed for the toilet. They thought it was capitalist speculative nirvana. And there was a well-known economist who said this country is now on a new plateau of permanent prosperity. And I should say that a lot of the theorists of things like that during the 1990s were Democrats. And they too thought, well, we have now reached a permanent plateau and the bubble will never break. So it's very hard to say that this is one partisanship or the other. I would assign more blame to the conservatives, but you know, so many of the other side are in there with nonsense too that it's hard to be definitive. And it's also true that people in the markets, the financial sector, they really don't like inflation. If there's anything that took them to the cleaners in the 1970s and early 80s, it was inflation. And I think they are determined to not have inflation. And the government statistics are basically the product of, I would say, 30 years of effort to, not find inflation until it's got the gun barrel on the back of your head and you can't do anything about it. And that's sort of what's happening now. Here's Bernanke. He's finally, maybe there is inflation, but it was all the sort of stuff that he's a big believer in that kept them blindfolded. And he just had silly, irrelevant comments in the beginning of August. It was all under control, nothing was going to happen. I think that we probably have a Federal Reserve Board that's missing the essential realities of the changing economy in important ways. And if that's the case, they're going to have a hell of a black eye by 2009, and then Bernanke won't be reappointed. I think that's a fair possibility. But remember that people in the bond markets don't want inflation because all of a sudden the bond prices would crumble, the rates would go up. They'd have to go much, much higher to pay people for the possibility of 6 or 7% inflation. And people in the equities side don't want bond prices to go high because then that's bad competition for stocks and it would push stock prices down. So while I don't think there's any conspiracy there, there's certainly a desire not to accept these things and to believe in the market as the forecaster and to believe in the efficient market. It vectors everything and it's never wrong. And obviously a lot of people are going to be right or wrong in a big way in 2009, but we still don't know yet. So the people that believe in all this are banging the drum and saying it's all going to be much better by the fall and the alarm shouldn't be taken seriously. I happen to be on the side that says taken very seriously indeed, but I wouldn't give it more than 7 or 8 out of 10. You never know, somebody could start a war. We have just the president to do it. Any others? Yeah.
When you spoke about the election and the Democrats finding a way to fail, I just wonder what your thoughts were about Hillary's comments, her hawkish comments on Iran, and then also her association in basically gaining the endorsement of Richard Mountain Scaife, and whether she can be actually, it just accents what you're saying, but is there really a Democrat there? Are we looking at 2 Democrats, or are we looking at one Democrat who is a pawn for the right? I just wondered what your comments were.
Well, she's not a pawn for the right, but I think she's got a vested interest in the policies and in maintaining a successful image for her husband's administration. And I think that's a pitfall. I think that they helped set the backdrop to Iraq in motion, and they helped set the financial bubbling and favoritism to finance and deregulation in motion. And she said that she would pick as her two financial advisors Alan Greenspan and Bob Rubin. As far as I'm concerned, those are people that helped this whole speculative and financial debt ball and bubble to go. So it's difficult for me to see that she's much of a solution here. She's probably a bigger solution than John McCain is, because he frankly admits he doesn't know much about economics. And certainly his proposal as to how he's going to reduce the budget deficit at the same time he cuts taxes is perfect proof of his earlier statement. I mean, there's no way something like that is going to work out. And I assume that he must know a number of people don't think that could possibly work. It doesn't seem to bother him too much. To me, Obama probably is the most open to achieving something because he's not bound to the past that much, but I think his sort of amateur sociology and wife, rural Pennsylvania, is frustrated, and his former pastor, who doesn't want to seem to give up too easily, they're problems for him. His judgment in dealing with those could have been better. And of course, Hillary and Obama really seem to, they want to bury the hatchet, in each other's heads. And how you're going to get them together, I don't know. It's sort of like Jerry Ford and Ronald Reagan, and they never did get together in 1976. Most of the Reaganites I knew didn't want to back Ford. They didn't want to vote for him in the election. They wanted to get some Democrat who wouldn't know what to do in the White House, so the Democrats would screw it up and Reagan could get in, and Jimmy Carter arrived. So the forward fumble is a famous thing in politics. But it's hard for me to see how the Democrats are going to pull this one off. I hope they do, but I wouldn't bet on a lot on it, not right now. Maybe it'll look very different in July and August.
I was wondering, do you think that a reorganized North America, a union with a new currency, the euro type, a marrow, could that work? Could that help?
I'm dubious. First of all, one of the things we've seen in some of these currency blocks is it makes difficulties for countries whose currency isn't close to the norm in terms of the prices or the resources or the deficits. And in the European Union, there have been complaints by some of the countries that they're sort of stuck with standards that work for Germany but don't work too well for them, Germany being essentially a pretty well-run economy. I don't know what would happen. Mexico is not well-run. Canada, and it's losing its oil. There's just less oil produced in Mexico all the time now. If you had a more effective North American Union, you lose control over the borders even more, I would think. As far as Canada goes, they're doing pretty well now because they have a commodity economy. And their dollar has come up, and it's presently slightly ahead of the American dollar, which makes things very difficult for American exporters. Makes things very difficult for Canadian exporters, and Americans can export into Canada better than they could. Canadians, I'm not sure that they would want to tie themselves to our currency valuations again now. So I would be very, very surprised. I think you're going to see a lack of progress towards any of these international blueprints for the next couple of years. That's not to say something new couldn't emerge, but I don't see that we would have a currency union with Mexico and Canada. I think that's unlikely.
Hi. Along the same lines, I had a question about this bipartisan addiction to free trade that has been the mantra for the last several decades now. And we had NAFTA, about which people expressed a lot of apprehensions at the time, went through, and the job losses because of that are documented to be quite high, and then we had CAFTA after that, and now we're pushing for other similar agreements. What do you think is the impact of, one reason for the falling dollar perhaps is that we don't make very much in this country anymore. And the jobs that we create are all probably in the government sector mostly, a lot of them.
I think a lot of the jobs created are government, health, retail, although retail's shrinking now. A lot of service jobs. I mean, the others have slid away. It's obviously clear that one of the dollar problems is that we don't manufacture nearly as much as we used to, and that some industries are so far gone that even a cheaper dollar won't help them. So I would say that I think that the free trade movement in the United States in the last 20 years has been dominated by people who are concerned about the success of the service industries, not least financial, and that they have just assumed that manufacturing was sort of yesteryear's thing and that it would work very nicely for the United States to become a service exporter. And one of the things we were exporting in 2007 up until August, and was being hailed very widely by people in Washington as the new export, were all these things like asset-backed securities, mortgage-backed securities, collateralized debt obligations, and all of a sudden now, boom, they don't want them. And they had previously, because they had these very highly rated tranches that they were selling, and they got Standard & Poor's and Fitch and Moody's to give these things AAA and AA. They were really worth something like double C or B. And because of that, they were bought all over the world, especially in Europe. And you had all these, like the Second Provincial Bank of Schleswig-Holstein bought $80 million worth, and they didn't know what was in them, really. And all of a sudden they find out what's in them is junk, notwithstanding the AAA rating. So they're really angry, and a couple of banks in Germany bit the dust because they were buying too much, deficient American financial products. So the extent to which we think that we can just say goodbye to the old types of things we did and we can start exporting our wonderful financial products, I think that some of that market collapsed in a big way. And the market for treasury debt is starting to show real signs of softness, but it would be premature to say it was really soft yet. But the Bloomberg today had a big piece on the Japanese are starting to sell dollars. So I would say that our financial exports are not doing too well. Now the British had a problem. The free trade debate became very strong in the first decade of the 20th century. But the conservatives who favored some degree of protectionism and reciprocity lost the debate, and free trade continued. But then in the 1920s and 30s, as British markets shrank even further and it was clear that finance could no longer really pick up the baton, at that point they started passing some modifications, put it that way, of free trade. They went to Commonwealth preference, which favored the Commonwealth countries and was taken as a move towards nationalism and some protectionism. So I don't think we're going to go too much further in the direction of free trade that's aimed at service industries, including finance. The record of finance in producing exports that people want has really slipped a couple of big notches in the last 6 months. But again, you don't see that on the front pages of the papers either.
Hi, I'm interested in structural and systemic issues. And if I'm thinking that our faith-based fractional reserve banking system appears to be fundamentally a Ponzi scheme, what would you say to disabuse me of that notion or to confirm it?
Well, I certainly wouldn't say that the Federal Reserve and the banking system is a Ponzi scheme. What I would say is that they have increasingly fallen into what I would call the bubble and bail business. And they bubble, which is to say there's a lot of liquidity. When financial institutions are in trouble, the liquidity gets even bigger. When rescues are necessary, they'll bail out a currency, they'll bail out bond issues, they'll bail out banks, they'll bail out hedge funds. They just bailed out a broker-dealer, Bear Stearns. So what you've got here is not a Ponzi scheme, it's an American version of Japanese capitalism, in which government basically decides to support an awful lot of the financial structure and bails it out, and you bind up the wound with the pus remaining in it, and there you go. The Japanese economy is sort of stagnant. It's been stagnant since the early 1990s. And any notion that Japan is going to be the economic leader of Asia is just totally down the drain. So I think what we're doing, it's not a Ponzi scheme, but the future vitality of American capitalism is probably at risk because of the way in which we're bailing things out just to save them. That is not the old creative destruction of the marketplace when, well, for example, even as late as 1969 and 70, there was a 35% dive in the stock market and a whole bunch of hedge funds went down, and something like 100 brokerage firms either vanished or merged into each other. So you had a lot of destruction. Well, they won't accept that now. And I think that the fact that they won't accept it, and it's somewhat like the Japanese pattern, is basically that you're circling the wagons around failure, you're circling the wagons around subsidies, you're circling the wagons around what I would think of as kind of a financial mercantilism. And that is not whatever genius American capitalism had in its earlier days. And so I don't think it's a Ponzi scheme, but I think it's a very unfortunate set of circumstances.
One of the more solid areas of growth in the financial services industry in America has been global remittances. And it's kind of interesting because I just remember so well when Hillary Clinton was helping her husband push NAFTA through, and people were saying, well, everyone was throwing Adam Smith's name around from the far right to the far left. And well, Adam Smith's idea was, yes, capital should be allowed to cross borders freely, predicated on the principle that labor should be allowed to cross borders freely. And so the Clintons had to answer the complaint from the left, well, why are you supporting NAFTA when NAFTA isn't freeing up labor to cross borders, only capital? And that's a disaster coming. And it seems to have been a disaster coming, and the Clintons would respond just the same way the Bushes were responding. Well, by creating a middle class in Mexico to import what we have to export, this will mean there will be fewer Mexicans wanting to come across the border here. And it just, none of it seemed to make sense. None of it took into consideration human nature or where xenophobic America was, and that America didn't have national health care the way the European Union did. So since I can't get any journalists to ask any of these candidates to do a cost-benefit analysis of NAFTA, could you do a cost-benefit analysis?
Well, not really, because you get into huge fights over whether the U.S. deficit with Mexico has more to do with manufacturers and automobiles or more to do with oil. And I've seen arguments, although their oil exports to the United States are going down at this point, you can make that case. You can also, you never get past the question as to how exactly you deal with subsidiaries of companies exporting to the parent company, and is that the same as a transaction between wholly unrelated people? But my sense of NAFTA is that it has benefited the service industries, it has benefited U.S. companies that wanted to relocate there, although some of them have now relocated to Asia, and that there is a sort of never-ending quest on the part of American business to implement things that put pressure on wages in the United States. And obviously the ability of the United States to move things to Mexico and to have Mexicans come into the United States. It's a long history in Texas of keeping your labor costs down by a perennial movement of Mexicans into Texas. And I think that the selfishness of the people who favor NAFTA and the trade programs is that they're not concerned with the reduction in American wages that flows from some of these patterns, and they're much more concerned about aiding the service industries, and finance is very prominent in that. And I do not think at this point that our future lies in promoting the exports of financial products, or for that matter in tolerating the present size and sort of de facto merger with Las Vegas that we have in the financial sector. It's not the way to go. And the trade agreements and the whole spirit behind them has really had a lot more to do with the sort of policies that were simultaneously vastly expanding debt and promoting the expansion of the financial sector. So I think that was a mistake in retrospect, and I don't agree with the trade policies, but I wouldn't leap to say that we jump out of NAFTA. I certainly would favor some partial reevaluation of it. Two more questions and that's it then.
If you have to pick one between globalization and protectionism, which one would you pick? And if you can answer that from the perspective of America as well as the perspective of the world as a total, which one would your answer be different for the two? Which one would you pick?
Well, I think I'll answer why I think it's an unrealistic question. I think the globalization patterns in history have been at least partially related to the supremacies of previous leading world economic powers. Most vividly, the British. In their early days, they were protectionists. That changed in the early 19th century. And they were for free trade down to the 20s when it started to change again as they got in trouble. I think that the period we're heading into will be one in which free trade and globalization is strained, and there's probably some reduction in trade coming, and more nationalism, certainly in the oil industry, more nationalism. So I think that globalization maybe has gone about as far as it's likely to go during the hegemony of the United States, and if the hegemony of the United States is being weakened, as I would put the odds are that it is, then I think the globalization associated with the hegemony of the United States is going to suffer somewhat too. It's pretty clear that the Asian nations, while they favor the ability to dump all sorts of manufactured goods in the United States, do not basically support free trade. They are state capitalists. They favor financial mercantilism, which is accumulating huge reserves and everything as part of their armory. So I think it would be unrealistic to assume that you would maintain globalization if the United States sort of loses its edge and you start getting this multipolar world economically in which you see the Asia coming up and the Russians coming up and Brazil coming up and the United States and Western Europe losing some of their previous leverage. Last question.
Would you comment on the possible benefit to our present, or as you see it, the immediate future circumstance that might result from circulating whatever money we have within the country and for the use of rebuilding significant, important infrastructure and in the realm of green energy technology and industries?
I'm skeptical in the near term of too much on green energy and technology, simply because if we are facing this partial peak oil problem, I think you're going to see the United States only put collateral emphasis on new technologies and new energy sources that still have to be preoccupied with oil and natural gas and coal. And the argument would be that you'd have to reduce the import of crude oil. You may have to come up with procedures for getting liquids from coal, lots of different things. And I suppose in the course of the next 10 years, you can develop geothermal and wind and some of these things. But I doubt that there's some huge amount of money there, a pot of gold at the end of the rainbow. People in the financial sector talk about the alternative energy practicality and possibility, and I'm not certain how much emphasis I'd put on them. And that was the second part of your question, and I forget what it was. Oh, yes. I'm sure we'll see some of that, but my guess is that state and local budgets and federal budgets are really going to be strained. We're headed towards another $500 billion federal budget deficit. The previous successful financial patterns in the states are facing the same problem. Revenues are shrinking rapidly. If the government decides at the federal level or at the state level to fund a huge infrastructure program along the lines of the New Deal, I suppose it could, but it would be probably enormously inflationary now, which wasn't a problem in the New Deal because that was a deflationary period and commodity prices were coming down globally. We seem to be in a different pattern. I'm not sure it'll last, but for the time being, I can't see the government having the money to do that. And the strain of entitlements and health programs and drug benefits and so forth is going to be gangbusters. It's going to be huge in 5 to 10 years. The only reason it's dwarfed by the private debt right now is the private debt is what's blowing up. It may be the public debt problem that is front and center in let's say, 2014 or 2016. So I can't see that we have the money for that. And if somebody can think of the way to get people to do it for nothing, you could rebuild the whole infrastructure if you took the prison population and put them out there. Well, we have a huge prison population. I don't forget the numbers, but it's just totally without a parallel anywhere else in the world. And they've started, some of the prisons are getting into for-profit industries. I suppose they could get into the infrastructure business. And instead of seeing people with orange suits holding up the sign to slow down, you could see people in striped outfits holding up the sign. I wouldn't totally laugh. But I think there are just a whole set of difficult circumstances facing us. I hope against hope, but I wouldn't bet too heavily that the politicians rise to the occasion. Thank you.
You've been listening to columnist and author Kevin Phillips talking about his latest book, Bad Money, Reckless Finance, Failed Politics, and the Global Crisis of American Capitalism. Kevin Phillips' other books include American Theocracy, The Peril and Politics of Radical Religion, Oil, and Borrowed Money in the 21st Century, American Dynasty, Aristocracy, Fortune, and the Politics of Deceit in the House of Bush, The Politics of Rich and Poor, Wealth and the American Electorate in the Reagan Aftermath, and Arrogant Capital, Washington, Wall Street, and the Frustration of American Politics. You can find out more about Kevin Phillips at the American Theocracy website at www.americantheocracy.net. This program was produced by pdxjustice Media Productions. To find out more about our work, please visit our website at www.pdxjustice.org. You'll find streaming audio and video programs featuring speakers such as Naomi Klein, Raed Jarrar, Susan Faludi, Amira Haas, and Jonathan Cook. And we'd like to hear from you. If you have any comments about our work or suggestions about how we can improve the quality of these video programs, please write to us at pdxjustice@riseup.net. Thanks for tuning in, and thanks for supporting listener-sponsored radio, public access cable television, net neutrality, and all forms of grassroots, democratic, community media.